Alright everyone, Cowboy Trades here, welcome back to the channel. So the markets are bouncing, the SP 500 has broken out of the top of this diamond bottom formation, and Bitcoin has also broken out of this bearish pennant. Now, is this just another fake out or is this bounce going to last? Let's talk about it. I'm going to start off on the news on why we pumped, we're going to dive into some SP 500 charts, and then we will wrap up the video on Bitcoin. All of this is timestamped, so if you want to, I know a lot of my audience just cares about the crypto content, if you want to zoom between different timestamps, that is what the timestamps are for. So first of all, why are we pumping? Well, the main reason why we're pumping is because we got job data came in that was better than expected. The US unemployment rate fell down to 3.5%, from the previous reading at 3.6%. Now, this was actually forecast to be coming in hot at 3.7%, above the previous, and it was below the previous. So there were a few other pieces of economic data that came out, but if you look at how the S&P 500's moved, as soon as this information came out, that is really what started to push up the market. So I won't comment on too much else. Now, in terms of economic data and news events that you need to be wary of before we do jump into our TA for today, we do of course have the CPI numbers coming out on January the 12th, which is of course Thursday at 8:30 a.m. Eastern Time. And also tomorrow we have the Federal Reserve Chairman Jay Powell speaking tomorrow at 9 a.m. Eastern Time. And before we do have our inflation data for CPI come out over on Thursday, we've got FOMC member Harker speaking at 7:30 a.m. So that's really all the economic data you need to be wary of. Let's dive into some S&P 500 charts, talk about what's going on in the market, and then of course wrap up the video on Bitcoin. So we previously talked about this diamond bottom formation, and we talked about how I personally did think we were going to be breaking down to the downside of this. Of course, lower time frames I was wrong. I can't be right on absolutely everything in these markets, so my bad on this one. But of course, as you can see, we have broken to the upside of this, and it looks like we're getting stopped out pretty hard at 3,973. I did post a little bit earlier over on Twitter while the markets were still pumping that I was going to make an update. By the time I've come over to the charts, you can see they have started to come down at this moment in time. Doesn't necessarily mean that we've topped out, but I do believe this is going to be a fake out. Of course, I'm sure veterans of the channel would have been expecting me to say that anyway. Let me show you a charts and talk about. Let me show you a few charts and talk about why I believe this. Now, of course, we had this diamond bottom formation playing out, but if we just draw a new trend line on this from this data point, this data point, and this data point. In fact, if you're using Wix, you could actually see its potential. We could come up to the 618 Fibonacci at 3,975 for the S&P 500 before topping out. But I do believe, a top is going to start showing itself very, very soon for the S&P 500. Now, once again, we've just redrawn this on a different chart. This is also the 4-hour time frame for the S&P, but this is just another bear flag. So, I mean, we've broken out of one pattern and we've just broken into a new higher time frame bearish pattern. And what's interesting about this is one of my favorite things about bear flags is a lot of the time when you break down and you form this nasty pole, a lot of the time you revert back to, this golden pocket region between the 0.5, 618 and 786 Fibonacci. And you can see we more or less came up to the 618 Fibonacci, halfway between the 0.5 and the 618. And it looks like we're finding resistance. Once again, I'm drawing this trend line through the candle body closes here. If we drew it up a little bit more, you can see that we didn't actually touch this trend line. So it really depends on how you want to draw this, but once again, 1 hour time frame, 4 hour time frame, daily time frame, weekly time frame, it really all does still look absolutely bearish from me. And one thing that is also quite funny is if we do zoom out on the daily time frame, you can see it was only a few weeks ago, the 13th of December, that we were double topping at 4,106, and we broke down from a huge nasty bear flag. I mean, look at this bear flag that was in play from the 16th of August, huge breakdown. And once again, fat fingering this one, but you can see approximately that we reverted back into this orange box like we normally do with bear flags anyway. So, it was only a couple of weeks ago that we were breaking to the downside of this nasty, nasty bear flag. And of course, we're breaking down, forming a new bear flag, and we're down here at 3,950, which is where we got stopped out earlier. And we're acting like it's a new bull market. So, of course, I'm sure, once again, veterans of the channel would have expected me to say this, but I absolutely do not believe the bottom is in. I will talk about financial conditions and why the Fed will, basically keep on raising the interest rates in the first place. But if we are looking at this, I'm still predicting that we're going to come down and fill this S&P 500 gap down here, which is about a 7.4% drop from where we're residing at this moment in time. Higher time frames, you can still see S&P 500 2008 fractal is beautifully playing out. If we come over to the weekly time frame, yeah, we've got a slight green candle coming in. We've had a few of these on dead cat bounces before, here and here, although technically you're not meant to count green doji candles in a downtrend on Fibonacci, so this one would really be the only other one that was similar to what we're experiencing right now. But if we are looking at this 2008 fractal, you can still see, while we've had a little bit of a push up, this kind of general market formation is still playing out, in my opinion. Now, the last chart that I do want to show you for the S&P before we do move on to a few other things before we wrap up the video is the fact that, once again, if we're coming over to liquidity conditions, really in the past week or so, they've started turning up and having a bounce. And we've talked about this many, many times where we've got top in liquidity, top in liquidity, top in liquidity, top in liquidity. And when we come over to this chart, you can see how these tops in liquidity affect the market. And we've mentioned this many times, so I'm going to fly through it. But you can see a top in liquidity, you see a breakdown. And yes, at this moment in time, it was new lows, but you can see you had a buyback, you had a dead cat bounce, and then you broke down and formed new lows. And then you can see a top in liquidity, huge breakdown, once again making new lows, but then you had a buyback in terms of liquidity before breaking down into new lows again. Once again, you can see over here, this bounce didn't quite make new lows, but you can see, once again, breakdown in terms of that top in liquidity, bounce back up. And most of these, this is a bear flag, this is a bear flag, this is a bear flag in terms of the buyback and liquidity before another break back down to the downside. You can see top over here, liquidity conditions actually topped over here. We broke down, had economic data which made us make a double top formation, and then you can see we've broken down since liquidity conditions have topped out. And once again, we're seeing that same buyback, we're seeing this same bear flag pattern that we've seen play out time over time again. This is not a new phenomenon in the macro time frames. This is the first, second, third, fourth time this is playing out. And every single time we have these bounces, everyone swears it's a new bull market before we obviously top out and come down and start making new lows. Now, besides the TA, besides looking at the charts, which is all well and good, these do help us navigate the market, but in terms of fundamentals, why does it not make sense for the markets to actually have a proper pivot at this moment in time? Well, I found this very interesting article over on Seeking Alpha written by MOTT Capital Management. He has a Bloomberg terminal, so sometimes I do like looking at these Seeking Alphas from people who share economic charts with Bloomberg terminals. So let's just read this very interesting point down here about the Fed funds 30-day rate. So basically, the owner of Mott Capital said to maintain the market's current view on inflation, CPI this week, which is of course coming out on Thursday, will need to come in as expected or cooler again. This matters significantly because a hotter than expected number could shift the curve higher again. And in terms of the curve, he's talking about the 30-day Fed funds rate, where they're predicting that we're going to come down to 3.5% or so. He also said because at this point the expectations is for CPI to fall by the summer, and that is the same time the markets is thinking that the Fed may not only have paused hiking rates, but the Fed may turn to cut rates. So if there is a delay in the rate of disinflation and it does not go as the markets predict, then it just means that the hopes of any rate cuts begin to melt away and get pushed further and further down the line. So a lot is riding on this CPI report and every CPI report to come. I definitely agree with this. This is the main statement that I want you to take away from this. All it will take is one or two hotter than expected CPI prints along the way to disrupt any hopes of the Fed cutting rates in 2023. And over here, you can see the US CPI, which is predicted to drop down into about the 7th month of this year, all the way down to a 2% rate. So, the CPI numbers, what they're predicting for CPI is for CPI literally every single month that we have the CPI numbers coming out now, all the way down to the 7th, to just drop month over month over month over month over month over month over month. And I just think that is not necessarily going to be the most likely cause of scenario, but let's say hypothetically it is. The veterans of the Cowboy family know why this is not necessarily, this is not good for the markets at all, because what happens when inflation starts dropping down? Well, This is often a sign that the economy is slowing, growth is slowing, and if you look at time, so right now we're looking at the US CPI index. We're not looking at it on an annualized year-over-year basis, we're looking at the actual US CPI. And when we do come over to the actual CPI, which is, once again, not a year-over-year index, sure, year-over-year is coming down, but this is only how much we've come down on the actual CPI index. Now, it topped out around about 298.12 a couple of months ago, October rather, and you can see at this moment in time we're all the way down at 297.7. So inflation has really not started to drop on the index. In terms of year over year, of course it started to drop because we had some huge inflation in the previous year, but that doesn't mean prices are coming down. I'm sure if you go to the store, you look at eggs, you look at beer, you look at rice, you look at chicken, everything is still overpriced, or not overpriced. This is the new prices that we're dealing with at this moment in time. But you can see when the actual CPI starts coming down, when the CPI index starts to break down to the downside, what does this mean for the markets? Well, we've talked about this many times before. In 2008, markets were breaking down as interest rates were raising, and when inflation actually started to come down because of the raising of the interest rates, when they started to plummet, when inflation started to plummet, you can actually see this part of the bear market, this part of the recession for the SP 500 was absolutely brutal once inflation started to come down. We've talked about this chart again, so I'm not going to spend any more time on this, but once again, it takes a while for inflation to come down. It takes a while to move into cheap accommodative monetary policy again, which is required for economic growth, which is required for bull runs. We've talked about all these things many times before on the channel. Just because the markets go up by a few percent absolutely does not mean that anything has changed whatsoever. And I actually am of the opinion that inflation could have topped out at this moment in time. We'll talk about why in just 1 second. We'll talk about it towards the end of the video actually. But once again, even if inflation hasn't topped out and we keep on pushing up, that's going to be terrible for the economy. If inflation has topped out and it starts breaking to the downside rapidly, we're going to once again see another we're going to once again see another pit stop. We're going to see economic growth start to diminish, and because of this, we will enter a recession. So I think at this point in time, there's really no way of avoiding this. And one thing to talk about just quickly is it was only 5 days ago, on January the 4th, that the FOMC minutes came out, and the Fed literally said, we talked about this before on the channel, the source is down here. You can go check out my channel 5 days ago. We posted the source for the FOMC minutes, but they literally said, further rate hikes are necessary. Rate cuts probably won't happen in 2023. And participants also welcomed, of course, the October and November inflation drops, but they agreed that it would take substantially more evidence of progress to be considered on a sustainable downtrend path. So I think we need to see at least another 2-3 months worth of inflation starting to come to the downside. And just like we saw in this mock capital post over here, once again, it only takes 1 or 2 hotter than expected CPI prints for the Fed to once again have to push their goal back of pivoting financial conditions again. And, once again, they said it's probably not going to happen in 2023, even if, like we see here in the Fed funds rates, how the US is predicting the CPI is going to play out. They're predicting it's going to drop every single month. All it takes is 1-2 months where it doesn't actually drop, where it stays at the same level, it comes in hotter than expected, and once again, this pivot in 2023 is absolutely not going to happen. Now, of course, in terms of the next FOMC meeting, we've still got about another 22 to 23 days to wait. This is coming in on the 1st of February, so we've got a long time until we've got any substantial Fed commentary. Of course, we've got Powell speaking tomorrow. That's going to be quite important, but FOMC meeting in the next start of February is going to be extremely important for the markets. Now, in terms of how CPI is actually predicted to come in, core CPI is predicted to stay the same this CPI meeting, which will of course once again put a spanner in the works for that inflation numbers to come down. However, the US headline inflation is actually forecast to be dropping down to 6.5%, and it's currently at 7.1%. So if this does happen, it's very likely that on Thursday we see a very sharp rally back up to the upside. I don't want to comment too much on this at this moment in time because I am going to get a video out on Wednesday talking about my full thoughts on the CPI report that will come out on Thursday. I'm going to be away on Thursday fighting in not a kendo competition. I'm going to be fighting in a kendo dojo on Thursday, getting training in for my competition in February. It always seems when the CPI numbers come out that I have training at that moment in time. But nonetheless, like I said, I'm going to get an extensive video out on Wednesday prepping you for all different scenarios that will come in the markets for that. And of course, if you keep up to date with my Twitter over here at 618_cowboy, I will keep you posted as the numbers come out anyway. So like I said before, I did want to talk about one other thing in terms of inflation. It seems that Michael J. Burry is also predicting that inflation has peaked, which is very interesting. So, once again, tie this in with the chart. If CPI starts to break down, this is going to slow economic growth. This is going to be a sign of economic weakness, and you're going to see the SP 500 take that final cascade to the downside and fall into a temporary recession. He also believes that it is going to come down, possibly negative in 2023, which I don't agree with. And then he believes that the US will once again have stimulation. They'll have fiscal stimulus come out. They'll have quantitative easing come out. And then once again, we'll have another huge spike in inflation. So, right now the markets are in really unprecedented places, but let's wrap up the video talking about what is going on in Bitcoin. In my opinion, really nothing of importance has changed whatsoever. Sure, we've broken out of a bearish pennant, which is a bearish technical analysis signal. You can see the pole down here forming the bear flag. We've broken to the upside of this bearish pattern. How far have we broken up? Well, not far enough that we've broken out of a bearish trajectory. You can still see that we are in, if I draw this from candle body close, or even if I draw this from the wicks up here. So if I move this down, you can see, just coming through these wicks here, you can even still see this trend line here. We've broken out of one bearish pattern and we found ourselves once again residing in another bearish pattern, which is, of course, not good. It really means, in my opinion, that absolutely nothing has changed. And this is, of course, a fake pump. Now, speaking of fake pumps, I've noticed something super interesting. I was looking through a few different charts, thinking about making a video titled, "Is this a new phenomenon?" blah blah blah, and it's really not. I'll just talk about this in this video anyway though. But you can see since we topped out at 69,000, we broke down and the rallies have been getting weaker and weaker and weaker and weaker. The first rally that we had was a 45% pump. You come down to the next major rally, you can see this was a 43% pump. You come down, if I come over to the daily time frame now so we can really see these lower ones. So once again, 45% pump, 43% pump. You can see the next major rally, which was this one here. I mean, sure, you can talk about this one as well if you want, but I consider this one, the next major one. In fact, let's look at this anyway. Let's encompass this data point. This was a 22.5% rally. What happened to the next one? This was an 18% rally. What happened to the next rally? All the way down here, this was an 18.5% rally, so pretty much just on par with what happened previously, a tiny bit bigger, but basically the same as before. And this rally that we've got right now, this new bull market, right? We're up 7% from this rally. So, this whole idea that we're breaking mega bullish and, anything has changed whatsoever is really ridiculous to me. If you zoom out, all of these rallies are just getting smaller and smaller and smaller over time. And what's quite interesting is we're still beneath the quote-unquote bottom that happened in June at 17,500. In fact, today we almost pushed up to it, 17,400. I'm not saying that we can't push up a little bit further, but in general, the rallies are getting weaker and weaker and weaker. If you wanted to know, I'm still sitting very cozy in my Bitcoin trade. It's 5x leverage, so I'm sleeping very well at night, and I have really no doubts in my mind that we are going to eventually break down to the downside and the trade will become massively profitable. Now, one other thing I want to wrap up on is this. In terms of EMA ribbon reversion, 69,000 we topped out, we broke to the downside, and you can see poked our head above the EMA ribbons, poked our head above the EMA ribbons, poked our head above the EMA ribbons, broke down. You can see over here, poked your head above the EMAs, poked your head above the EMAs, poked your head above the EMAs, broke down. Poked your head above the EMAs, broke down. Poked your head above the EMAs, broke down. Over here, you can see you poked your head above the EMAs and broke down. And what are we doing right now? Well, once again, I'm not saying at this immediate moment in time that we can't push up a tiny bit further, but if you look at the history of every single time this happens, it's very black and white. People are acting like the trend has changed, like the bottom's in, like this is a huge rally that we've never seen before, but this is not the case. Rallies are getting weaker and weaker. We've broken out of one bearish pattern and found ourselves in another one, and of course we are still having these reversions to the mean, and every time we poke our head above these, we just make new lows again and again and again. So, you know, of course, in terms of what happened in the lower time frames, it looks like I was wrong about the diamond pattern breaking to the downside in the immediate short term, and of course I was wrong about, in the immediate short term, this bearish pennant breaking to the downside. But does that mean I've lost confidence in all of my analysis? Absolutely not. Every single thing that we've been looking at in the channel for the past, you know, couple of months, not couple of months, you know, 8, 9, 10 months, I forget how long we've been bearish for, it's been a while, but everything is absolutely still playing out in the mid to higher time frames. In my opinion, this is really just a quick liquidity grab, which I talked about in my previous video. We've obviously pushed up a tiny bit higher since then, but all of my analysis, all of my thoughts with the general economy, with the fact that, you know, financial conditions pivoting will, you know, push the markets back down to the downside for one final low. And once again, we've broken out of one bearish pattern and broken into a new bearish pattern. Nothing has changed. That's all I've got for you for this video. Like I said, I'm going to be away on Thursday, but I will make an extensive update over on Wednesday, and I'll also try and get some content out for you tomorrow. But for today, that's all I've got for you. If you want more of my data, more of my posts while I am away from YouTube, be sure to head over to my Twitter at 618_cowboy. That's all I've got for you for this video, my friends. As always, it's been your boy Cowboy Trades. I'm out. Peace.